Thank you and welcome to another My Solo 401k Financial YouTube webinar. We're also on LinkedIn. Thank you so much for joining. We're waiting for the viewers to join and then we'll get started momentarily. We're also going to confirm the audio. So the audio has been confirmed. We're going to get started. So please, we would ask you to like and subscribe if you're watching on the YouTube channel. If you're not able to stay for the whole session, you can come back later and watch the recording. We're going to start with some housekeeping before we get into today's topic, which is its Solo 401k Contributions Deep Dive webinar for 2021 and 2022, specifically for those businesses that are taxed as a partnership or a multi-member LLC, where they're filing a 1065 and the earned self-employment income is reported on a K-1. So as far as the housekeeping, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So as far as resources, we do want to highlight that we have webinars every day on our community, which is mysolo401k.net/my community. And you can see, for example, tomorrow we'll be hosting our another deep dive contribution session at 1 p.m. Pacific, 4 p.m. Eastern on the community, focused on Mega Backdoor Roth Solo 401k for businesses taxed as a partnership. Next week, we'll be hosting sessions, more deep dive sessions. These will be focused on self-employed businesses taxed as a sole proprietor, a 1099 independent contractor, or a single member LLC. We also have forums where you can post questions every day, 24/7, and you can see what other folks are posting. We're responding to these questions throughout the day. So that's another great venue to share the knowledge. So the focus again for today is partnerships, multi-member LLCs, those businesses that file a 1065 and for which you receive and report the earned self-employment income on a K-1. So anytime we want to start talking about contributions and how much I can contribute to a solo 401k, we want to keep in mind that the contribution limits are based on different factors. Number one, your self-employment income, because you can't save more than you earn. Your age, because once you're 50 or older, you can make additional what they call catch-up contributions. Whether you participate in another plan, like a 401k through a day job, and the type of contribution that you're looking to make, whether that's employee or employer, pre-tax, Roth, or voluntary after-tax. In terms of your self-employment income, if your business is taxed as a partnership, your ability to make contributions is based off of the self-employment income reported on line 14 of your K-1, less 1/2 of the self-employment tax. So you have to run that pre-calculation, and our online calculator will run that calculation for you. Keep in mind that you don't consider W-2 wages from other sources like a day job. You also can't make contributions based off of investment income that you receive. So again, the first step is to calculate your self-employment compensation to determine your earned income. So it's net income reported on line 14, code A of the K-1, less 1/2 of the self-employment tax. Next, you need to determine, okay, for which year are you looking to make contributions? Because the overall limit was increased from 2021 to 2022. The overall limit for 2021 is $58,000 or $64,500 if you're 50 or older. For 2022, the overall limit increased to $61,000 or $67,500 if you're 50 or older. Next, you determine the contribution type. So with the solo 401k, you're both the employee as well as the employer. So you can make both employee as well as employer contributions. Employee contributions can be made as pre-tax, Roth, or voluntary after tax. Roth contributions are specifically a type of employee contribution. So as you'll see, as we look at the rules, they're subject to that employee limit, but they do include the catch-up amount. So if you're 50 or older, you can make an additional $6,500, assuming that you have the self-employment income to justify the contribution. Employer contributions, on the other hand, are always pre-tax contributions. Employer contributions are also not affected by contributions made to a day job 401k plan. Because unlike the employee limit, which applies at the employee level, contributions made to another plan sponsored by an unrelated employer, like a day job plan, don't reduce how much you can contribute to the solo 401k as an employer contribution. And then lastly, as we'll see, our plan allows for voluntary after-tax contributions. So we'll take a look at those rules. So let's dig a little deeper and look at the different limits based on the different types of contribution. So first, we're going to look at the pre-tax employee contributions. Employee contributions are also referred to as salary deferrals. So the limit is 100% of your self-employment compensation. If your business is taxed as a partnership, that means, again, you take line 14 of the K-1 less 1/2 of the self-employment tax. And you can contribute up to $19,500 for 2021, or an additional $6,500 if you're 50 or older. For 2022, the limit increased to $20,500 or $27,000 if you're 50 or older. You do need to reduce by any contributions made to another plan, such as a day job 401k plan. The only exception is if the other plan is a 457 governmental plan. In that case, contributions are not aggregated. What about Roth? Well, Roth, those employee contributions, those salary contributions, if your plan allows for Roth contributions, like ours does, can be made as a Roth contribution. So the limit is the same, 100% of the self-employment compensation, which again is the product of that pre-calculation, line 14 of the K-1 less 1/2 of the self-employment tax. So 100% of that amount, not to exceed $19,500 or $26,000 if you're 50 or older for 2021, or $20,500 or $27,000 if you're 50 or older for 2022. Roth contributions do need to be deposited into a separate sub-account. And you'll see as we go through the slides, we illustrate how those separate sub-accounts work. Now, employer contributions, again, are always pre-tax contributions. So there's no such thing as a Roth employer contribution. Employer contributions are also referred to as profit-sharing contributions. So that's another synonym or name. The employer contribution limit is 20% of your self-employment compensation. So again, you run that pre-calculation, line 14 of the K-1 less 1/2 of the self-employment tax. Keep in mind that the total contributions that you can contribute to the plan can't exceed the overall limit. So $58,000 or $64,500 if you're 50 or older for 2021. The overall limit increased for 2022 to $61,000 or $67,500 if you're 50 or older. Remember, the employer solo 401k contribution limit is not impacted or reduced by contributions made to another plan by you or on your behalf by an unrelated employer, like the day job plan, unless that other plan is a 403b. So if you have a 403b and contributions are made by you or on your behalf to that 403b, you have to aggregate those contributions with the contributions made to the solo 401k to make sure that the total contributions don't exceed the overall limit. So again, it's 20% of that self-employment compensation. So if your self-employment compensation is $100,000, you can contribute $20,000 as an employer contribution. Now let's turn to the voluntary after-tax limit. So voluntary after-tax contributions are how individuals that have a plan that allows you to do so, like our plan does, or how those individuals make so-called Mega Backdoor Roth contributions. Because as you can see from this slide, the voluntary after-tax contribution limit is higher than the Roth Solo 401k contribution limit. Again, that Roth contribution limit is really the employee contribution limit. You can make additional contributions above and beyond that, assuming you have a plan that allows you to do so and you have the self-employment compensation to justify it, as a voluntary after-tax contribution, and then convert the money over from the voluntary after-tax sub-account to the Roth Solo 401k sub-account. So in short, that's how individuals are making Mega Backdoor Roth contributions. So let's take a look at the limit. The limit is the lesser of your self-employment compensation. Again, self-employment compensation is the product of that pre-calculation. Line 14 of the K-1 less 1/2 of the self-employment tax. So the lesser of that number and the overall limit, right, which is 58 for 2021 or 61 for 2022, reduced by any other contributions that you make to the plan. So not impacted by contributions made to another plan like a day job plan, unless the other plan is a 403b. The limit doesn't go up if you're 50 or older, but you also don't have to reduce it by catch-up contributions that you make to the solo 401k. So effectively, you can still get to the $64,500 or $67,000 limit if you're 50 or older. And lastly, voluntary after-tax contributions must be deposited into a separate sub-account. So it's like the Roth. So you could end up having 3 accounts: a pre-tax account, a Roth account, and a voluntary after-tax account. And if you have 2 people participating in the plan, like a husband and wife, now you've got 6 accounts: pre-tax, Roth, and voluntary after-tax for each person. So let's take a look at how these different rules play out by looking at different scenarios. We're going to start with the baseline scenario, we're going to tweak the assumptions to see how the rules and the contribution limits work. So with our baseline scenario, we have a self-employed business taxed as a partnership, or multi-member LLC taxed as a partnership, one person participating in the plan who's under 50 years of age, who does not make contributions to another plan, whose goal is to first maximize the pre-tax contributions, and then if any additional contributions can be made, to make those contributions as Roth and or voluntary after-tax contributions. And finally, this individual has $100,000 of self-employment compensation. So line 14 of the K-1 less 1/2 of the self-employment tax is equal to $100,000. So this person could first make a $19,500 contribution as a pre-tax employee contribution for 2021, or $20,500 as a pre-tax employee contribution for 2022, because 100%, the limit is 100% of that self-employment compensation, dollar for dollar, up to $19,500 for 2021 or $20,500 for 2022. Next, this person could make a $20,000 pre-tax employer contribution. Remember that employer contributions are always pre-tax contributions, and the limit is 20% of the self-employment compensation. They would still have additional contributions that could be made as a voluntary after-tax contribution, because remember, the limit is the lesser of the self-employment compensation, which we're assuming is $100,000, or the overall limit, $58,000 for 2021, $61,000 for 2022, reduced by any employee or employer contributions made to the plan. So for 2021, that means they can make an additional $18,500 as a voluntary after tax. And for 2022, they can make an additional $20,500 as a voluntary after tax contribution, and then move the money over either to a Roth Solo 401k or Roth IRA by making a so-called Mega Backdoor Roth contribution. So at the end of the day, for 2021, this person would have $39,500 in their pre-tax Solo 401k sub account and $18,500 in their Roth Solo 401k sub account. For 2022, they'd have $40,500 in their pre-tax Solo 401k sub account and $20,500 in their Roth Solo 401k sub account. So now let's change the assumptions. Now let's assume the person has $50,000 of self-employment compensation. What changes, if any? So the pre-tax contribution limit is, and what is contributed as a pre-tax employee contribution doesn't change. The employer pre-tax contribution amount does change because now it's 20% of a lesser number, 50 instead of 100. So this person now makes a $10,000 pre-tax employee contribution. Also, the voluntary after-tax contribution amount changes because remember, the voluntary after-tax limit is the lesser of the self-employment compensation, which is 50, or the overall limit. So now we're using 50 as the limit. So 50 less the employee and the employer results in $20,500 that's able to be contributed for 2021 to the voluntary after-tax Solo 401k sub account, and $19,500 that's able to be contributed for 2022 to the voluntary after-tax sub account. So now let's go back to the base. Now the person again makes $100,000 of self-employment compensation, but let's assume that this individual maximizes the contributions made as an employee to their day job plan. So this means that they're not able to make any more employee contributions to the Solo 401k. They can still make the employer pre-tax contributions because the employer pre-tax contribution limit is not impacted by contributions made to another plan sponsored by an unrelated employer, like a day job plan. Likewise, the voluntary after-tax limit is not impacted by contributions made to another plan by an unrelated employer. And since this person has more, has $100,000, which is more than the overall limit for both 2021 and 2022, they could contribute the difference as a voluntary after-tax contribution. So that means for 2021, they could still make another $38,000 as a voluntary after-tax contribution. And for 2022, they could make another $41,000. So now let's go back to the base and let's assume that this person is not interested in making pre-tax contributions. Their goal is to maximize Roth and or voluntary after-tax contributions. So what changes? So the person would still make a $19,500 employee contribution for 2021 or $20,500 employee contribution for 2022, but instead of making that contribution into their pre-tax Solo 401k sub account, since they're not interested in pre-tax Solo 401k contributions, they would deposit that money into the Roth Solo 401k sub account. They would skip the employer pre-tax contributions because those are always, and they would skip the employer contributions because they're always pre-tax and they're not interested in pre-tax, and then make the difference, $38,500 for 2021 and $41,500 for 2022 as a voluntary after-tax contribution, and then move the money over to their Roth Solo 401k sub account. So at the end of the day, they would have $58,000 for 2021 in their Roth Solo 401k sub account and $61,000 for 2022 in their Roth Solo 401k sub account. So now let's go back to the base, and it's really the same numbers, but what we're changing is that there's two participants, right? It could be a husband and wife or the two business owners that own the business that sponsors the Solo 401k. So what, if any, changes? Well, nothing changes in terms of the amount. The point we're trying to convey is that the ability to contribute to the plan when you have multiple participants is based off of each person's scenario, each person's self-employment income, their age, etc. So since each person's in the same bucket, each person can contribute the same amount. So now let's go back to the base and let's assume that the person's greater or 50 or older. So what changes? Well, nothing changes in terms of the amounts other than the fact that now they can make an additional $6,500 catch-up contribution, which would be made as an employee contribution into that pre-tax account. We also can see from this slide that the voluntary after-tax contribution amount didn't change. Why is that? The overall limit doesn't go up for voluntary after-tax contributions, but you also don't have to reduce what you can contribute to the voluntary after-tax sub-account by catch-up contributions made to the plan. So that effectively means you can still contribute the same amount. Let's go back to the base and make a different change. So now the person's back to being under 50 years of age, $100,000 of self-employment income. They maximize contributions, the employee contributions to a day job plan, but this person is only interested in Roth and or voluntary after tax. They can't make any employee contributions because they already made and maximized those in contributions to their day job plan. They're not interested in employer contributions because employer contributions are always pre-tax. So they just make the entire amount, the $58,000 for 2021 or $61,000 for 2022 as a voluntary after-tax contribution. So now let's go back to the base. Similar scenario, but this person's 50 or older. They still have maximized the contributions to the day job plan, right? $26,000 for 2021 or $27,000 for 2022. So what, if any, changes? Nothing. They still can't make employee contributions. They still don't want to make employer contributions, and they just put the entire amount as a voluntary after-tax contribution. As we can see, and as we know at this point, the voluntary after-tax limit doesn't go up when you're 50 or older. So let's go back to the base. So the person is now back to being under 50, and now there's two participants, right? The goal still is to maximize Roth and or voluntary after-tax. So what changes, if anything? Nothing. So the key, again, message with this slide is that the limit is based on each person's scenario. And since each person is in the same scenario, each person is contributing the same amount. So that takes us to the end of this contribution scenarios. So we want to turn now to highlighting our online calculator. You can find our online calculator on our website, mysolo401k.net. There's a drop-down menu under Learn if you click on Online Tools. So for someone whose business is taxed as a partnership or a multi-member LLC, taxed as a partnership, you want to choose unincorporated sole proprietorship from the business type. That's the best option and the option that would apply. For net income, you will enter line 14 of the K-1. So the calculator will determine what 1/2 of the self-employment tax is. You enter the age of the person, right? If they're under 50 or 50 or older, just enter the age. And then you can run the calculation, you can view the report, you can print a copy. You can print, to keep a copy for your records. Keep in mind that the calculator doesn't contemplate if you're making contributions to a day job plan. So you would need to modify. The calculator also doesn't contemplate if you're looking to make after-tax contributions. So you would need to modify. So once you've determined how much you can contribute and how much you want to contribute, it's now time to make the contribution. So you can make that contribution by check or by wire. You deposit it into the applicable Solo 401k account, and you report the contribution. So let's dig a little deeper. How do I make the contribution? Again, it can be made by check. It can be made by wire. If you want to make the contribution by check, you could do so by simply making the check payable in the name of the Solo 401k and writing annual contribution on the memo section of the check. If you want to make the check electronically, you want to check with the financial institution that has your account for your solo 401k to determine their procedures to receive that electronic deposit. We have many clients who we have helped establish accounts for their solo 401k at a brokerage. The general rule for deposits, electronic deposits from external accounts at the brokerages, is that they're not accepted unless the name on the external account is in the name of the plan, because it matches the name of the account at the brokerage. The one exception to that general rule for brokerages is Fidelity, where they will accept electronic deposits from an external account where the name on the external account doesn't match the name on the account at Fidelity. If you have multiple participants, each person is depositing his or her contributions into separate sub-accounts. One account in the name of the plan for, say, the husband, a second account in the name of the plan for the benefit of the wife who is participating in the plan. If you're making pre-tax, Roth, and or voluntary after-tax contributions, those contributions likewise need to be deposited into separate sub-accounts. You may make the contributions in one lump sum or a series of contributions. You may transfer the money from a personal or business account. Either is acceptable from a solo 401k contribution perspective. When is the deadline to make contributions? Well, it's clear based on IRS publication 560, which is the landmark publication for self-employed retirement plans like solo 401ks. There's a chart on page 3 that makes it crystal clear that the deadline to make contributions, all types of contributions, is the business tax return deadline, including any timely filed extension. So again, this is for all types, employee and employer. So for a business that's taxed as a partnership or an LLC taxed as a partnership, for 2021, the contribution deadline is March 15th of 2022, or if a timely business tax return extension is filed, September 15th of 2022. For 2022 solo 401k contributions, as long as the plan is established by December 31st of 2022, you'll preserve the right to make contributions for 2022 up until the business tax return deadline, including any timely filed extension in 2023, right? This is exactly what is confirmed by IRS publication 560. So for 2023, that'll be March 15th of 2023, or again, if a timely extension is filed, September 15th of 2023. Next, how do I report contributions? Well, it depends on the type of contribution that you're referring to. So if it's a pre-tax employee contribution, it's reported on line 15 of Schedule 1 of the 1040, as well as line 13 of your K-1 using code R. If it's a Roth employee contribution or a voluntary after-tax contribution, it's not reported. If it's an employer contribution, it's likewise reported on line 15 of the Schedule 1 of the 1040, as well as line 13 of your K-1 using code R. Now, it's noteworthy that voluntary after-tax contributions are indirectly reported because when the funds are later transferred from the after-tax account to the Roth Solo 401k or Roth IRA, that needs to be reported on the 1099-R and then also reported on the 1040. But as you'll see and we'll go into great detail on this when we have our Mega Backdoor Roth sessions starting tomorrow in the community at 1 p.m. Pacific, 4 p.m. Eastern, and then again on our YouTube channel at 11:30 a.m. Pacific, 2:30 p.m. Eastern. We'll talk about the 1099-R and how it's also reported on the 1040, but it's really the conversion that's being reported, not the contribution. The contribution is not reportable if it's a voluntary after-tax solo 401k contribution and the business is taxed as a partnership or a multi-member LLC, taxed as a partnership, filing the Form 1065. So what about matching contributions? That's a very common question. So matching contributions don't apply to a solo 401k. You cannot make matching contributions. Matching contributions only apply to a full-time employer plan, like your day job 401k plan, where you have a 401k through your employer. Solo 401k contributions only consist of employee and profit sharing contributions. So to clarify, matching is when the employer matches what the employee has contributed. As we saw from our scenarios, you can make a profit sharing contribution to the solo 401k even if no employee contributions are made. So matching contributions are contingent on the fact that an employee makes a contribution. With a profit sharing contribution, which is an employer contribution, again, those contributions can be made even if you have even if you don't make employee contributions. Because let's say you maximize your employee contributions to your day job plan. What is not a contribution? So the following amounts are not contributions and therefore not subject to the contribution limits. So funds that you roll into the solo 401k, right, from a pre-existing retirement account, like a former employer plan or a non-Roth IRA. These are monies coming into the solo 401k, but it's not considered a contribution and therefore doesn't count towards your contribution limit. You can roll in as much as you want. Earnings from your solo 401k investment, right? Like if you invest in real estate, which is one of the most common use cases for our clients, the tenants of the real estate that's owned by the solo 401k will be paying rent back to the solo 401k. So of course, those rent checks need to be deposited into the solo 401k account. Again, money coming into the solo 401k, but not a contribution. Doesn't reduce how much you can contribute because it's not subject to the contribution limits. Amounts converted. So it's very common that folks are converting money from, say, the pre-tax solo 401k account to the Roth solo 401k account because they wish to process an in-plan Roth conversion. Or maybe the after-tax solo 401k account to the Roth solo 401k account because they're making a Mega Backdoor Roth contribution. Both of those scenarios are not considered to be contributions and are not subject to the contribution limits. You can convert as much as you want from your pre-tax solo 401k account to your Roth solo 401k account. And lastly, repayment of solo 401k participant loans. Again, a very common use case where folks want to be able to borrow from their solo 401k. So our plan allows you to borrow up to 50% of the balance, not to exceed $50,000. We prepare the required loan documents as part of our service, and then you, including a payment schedule, and then you make the payments back to your solo 401k account according to that payment schedule. Again, money's coming back into the solo 401k, but it's not considered a contribution and therefore not subject to the contribution limits. So that takes us to the end of the slides that we wanted to present. Thank you so much for viewing. Please let us know if you have any comments. You can continue the discussion in our forums on our community, mysolo401k.net/mycommunity, where people are posting questions throughout the day. We're responding. You can post questions 24/7. Again, we do host daily webinars, and we're in the middle of our contribution season. So we're hosting webinars, these deep dive sessions on contributions. So we'll be continuing the partnership and multi-member LLC tax as a partnership focus for the next 2 days. Next week, we'll be focusing on contributions for self-employed businesses, taxed as a sole proprietorship or a 1099 independent contractor or single member LLC. So we encourage you to join and follow our community. And we certainly appreciate, again, the participation today. We would, again, ask you to like and subscribe if you're on the YouTube channel. And please, continue to follow us and engage. We do have a little bit of time if there's questions. Well, it doesn't look like there's any questions. So again, thank you for the participation and all the best. Take care.